This is James, and you're watching Tixee Live. And a very good afternoon to all of you, and all of you a very happy Friday. In today's program, I want to discuss, and ask the question whether or not this bear market rally, which we've seen over the last week or so, is running out of steam. And are we getting ready to see the market return to a more bearish behavior? And a couple other things as well as that. But before I get into all of that, don't forget, these little videos are for educational purposes only, and in no way whatsoever should they be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So I just want to have a little look at whether or not we're seeing the signs that this bear market rally is slowly running out of steam. Because don't forget, on the back of last week's CPI, and then followed up by this week's PPI, investors have rushed into equities. In fact, it's been the fastest pace of people rushing into equities in the last 8 months. Now, I'm not the only one beginning to ask the question if this bear market rally is going to eventually run out of steam. Bank of America warns, though, that they believe this rally will fizzle out. So they're a little bit like me, thinking that this rally is eventually going to start to drop. And we'll have a look at the markets in a moment. At the moment, as it stands, last week was extremely good week for the markets. However, equities look set to close on a weekly loss. This is what Bank of America's one of their top strategists had to say, Michael Hartnett. He said, "We predict a policy pivot only in June and July 2023, and that expecting easing before that would be a big mistake." Basically, what he's saying is obviously the reason why we have had such a rush into the market is obviously with that CPI coming in lower. Remember, year-on-year is 7.7 versus 8.8% expected, and core was 6.3 versus 6.5 expected. The market got itself into a little bit of a frenzy, thinking this means the Fed's going to pivot pretty soon. And yes, there is a good chance that at last the Fed will only raise interest rates by 50 basic points in December. They have not said anything about pausing. They've said about doing less increments or smaller basic point rate hikes, but they haven't said anything about slowing down. And he goes on to say this: he believes a fair chunk of the bear market rally is indeed behind us. So he thinks it's about to reverse and about to go back again. Because now it's not only there is a debate, there's another debate. We have a debate about 50 basic points, 75 basic points. Will they stop? Will they pivot? Now there's another debate going on between the banks and market strategists. And because we know in my opinion, they're not going to stop. Okay, they're going to get interest rates up to maybe 5.25. Don't forget, yesterday, James Bullard, he's believed that interest rates will need to go between 5 to 7% to get on top of inflation, which is frightening when you think about it. That's a very, very high interest rate. But now there is always a debate about where they're going to go with their interest rates, how much basic points they're going to go. But now there's the debate, and there's this belief going among the central the investment banks, that they believe that Fed will cut interest rates, and when the Fed will cut interest rates. These are the believers, okay? UBS, started off with UBS. They believe that the market will see 175 basic point cut by the middle of next year. Barclays sees a 75 basic point rate cut in the final months of next year. Now, don't forget, Barclays also predict that the Fed to raise interest rates to 5.75. Okay, 5.75. Deutsche Bank predicts that the Fed will reduce interest rates by 100 basic points in the final 4 months of 2023. So there's this ongoing debate, not just where interest rates are going to go, but now when the Fed is going to cut them. When the Fed's going to cut them, which I think, to be fair, is a little bit foolish, because I don't think the Fed be rushing to cut interest rates until we see inflation come down to 3%. And we're at 7.7. So we have a long way to go before we can get to 3%. Actually, this is the same sort of belief that a number of JP Morgan believes. They won't reduce till we get to 3%, and we're a long way away from that. Long way after that. There's also non-believers, though. There's non-believers. They won't do a cut next year, which I think I'm more in that camp, to be honest. Unless, like I say, we see inflation come down to 3%, I don't think the Fed will cut interest rates at all. Goldman Sachs and Wells Fargo, they believe rates will peak at 5.25. I can potentially see it there, and staying there for the whole of 2023. And the reason I to explain to you the reason why I believe this, why I say this, is because those of you who've noticed or listened to what Jay Powell has spoken in the past, he's talked a lot about the 1970s. The 1970s. So don't forget, back in the 1970s, the Fed increased interest rates quite dramatically. Okay, similar, and then they reduced them really, really quickly. And it pushed them into a massive recession. Now, Powell is convinced for any action before they can fight inflation, it's going to cause the same sort of reaction like it did in the 70s when they reduced too quickly and too soon. So he keeps talking about this 1970s. So this is more why I'm in the Goldman Sachs, Wells Fargo camp, as opposed to UBS, Barclays, and Deutsche Bank, because I'm with them. Unless, like I say, unless we see inflation get down to 3%, they will not cut interest rates. They will stop slowing down on increments, by all means. We know they're going to do 50 next month after doing 75 4 times in a row, but they're going to do 50 and maybe 25 in January. They won't stop until they hit a certain level, but they may stop, may pause, but they ain't going to reduce until they achieve at least the target. Well, their target's 2. At least they see inflation coming down to 3. So that's how I feel about it too. 1970s. Imagine what Powell's hair was back in the 1970s. I wonder if he had anywho, because he seems to be obsessed with the 70s. So it's obviously in one of his favorite eras. But anyway, let's have a quick look and see the market. Let's start off with the equities at the moment. This is on a weekly chart. I'm going to illustrate that, like I say, at the moment, if you look at last week on the back of that CPI reading, which was incredibly impressive, we are set to close on a slightly, on a loss this week. It seems to be really struggling to stay above the 4,000 or get to the 4,000 mark again and stay above it. Currently down again today with losses, currently trading at 3,951 points. Key for me really now, I'm going to be keeping an eye on, is around the 3,940 point region as a potential area of interest. The NASDAQ, again, like I say, if you look at it currently at the moment, again, also feeling the pressure at the moment, 11,651 points. Again, like I say, like the S&P 500, is set to close the week with losses, and the same with the Dow as well. Like I say, had a very good week last week, like they all did, because of obviously the frenzy the market got into because of that CPI reading. Currently trading 33,633 points. If you look at the currencies, because the currencies have had a slightly better week, actually. If you start off with the euro, okay, they've maintained its momentum pretty much against the dollar this week. Currently trading at 1.03456. I also think today was driven by the very hawkish press conference of Christine Lagarde, indicating and promising further rate hikes to come. And if we look at it on a weekly, again, this is going to close not massively, but again with gains. The sterling's the same. Okay, despite that little setback a couple of days ago with the budget reveal, has also benefited on the weaker dollar and slightly more stability because of this latest autumn statement as well. A lot better than the previous one from the previous Chancellor of Exchequer 2 months ago, which has spooked the markets completely. Currently trading at the moment at 1.119028. The one thing which is interesting for me at the moment, which I'm keeping a close eye on, is the gold market, actually, it's the metal market, because I am seeing, again, it's been benefiting as well, I am seeing a bit of a sell-off at the moment. Currently trading around $1,755. I think at the moment it's a mixture of a little bit of nerves about what was said yesterday by Bullard, but I'm also thinking it's a bit of profit taking as well, because obviously if you have a look on the daily, it's been making some nice gains over the last couple of weeks, but since the last 3 trading sessions, we start seeing it cooling off a bit. Still, the key for me at the moment is $1,726 as a potential area of interest for support. Still $1,800 and $1,803 for a potential area of interest for resistance. First stumbling block for resistance, though, for me, it's going to be $1,790.45. So yeah, that's what we have going on there. Let's have a quick look at the Bitcoin as well, because we all know the Bitcoin is luckily calmed down over the last couple of sessions. Been in the news this week as well. Has feel the pressure, but currently trading at $16,640. So yeah, what a week we have had this week. It's been a really interesting week. A lot of drama is normal. Like I say, we've had the crypto crisis at the beginning of the week with FTX, obviously filing for bankruptcy, which spooked the whole crypto market completely. So we've had a bit of the crypto crisis this week as well. Then we've had the Fed speaks. Like I said yesterday, it's like a TV reality show, the Fed speaks. We've had so many Fed members speaking, all indicating, and it's all of them have said this, none of them has said anything opposite. And Mark finally listened yesterday. All have said, okay, yes, they might do smaller basic point rate hikes, but not one of them have said they're going to stop or cut. But the market still lives in that anticipation that they will. Then, what else have we had? Oh, yes, poor old Elon Musk. He said he's got too much on his plate. He works too much. He's working so much harder because he's obviously got the 2 companies. And that's spooking the market as well, especially those people who are trading in Tesla. They're worried that his distraction with Twitter is going to make Tesla suffer. So that was in the headlines. UK inflation went to 11.1%, the highest in 41 years. And the worrying thing was that, though, even worse than that, there was ONS, as did say that if the government hadn't done the support for the energy bills, the inflation would be at 13.3%, which is frightening. Then, of course, yesterday, we had somebody burst a bit of the bull's bubble because James Bullard, he says he can see the interest rates going anywhere as high as between 5 to 7%. And today, the main story, obviously, has been people flying the nest at Twitter. The mass exodus of staff who's resigned and leaving, with Twitter offices having to be closed till at least Monday. So there we go. So what a week. What an interesting week we've seen. But guess what? We've got another week to come, another exciting week to come next week. We have Canadian retail sales, German manufacturing PMI, UK services PMI, US durable goods, and the big one for me, the FOMC minutes, followed by the German GDP. Talking about the FOMC minutes, that is where we really might see the bear market rally start to really come to an end, depending on what's in those minutes. Okay, if the minutes are considered dovish or hawkish, that's going to be the big event next week, the FOMC minutes. Like I say, that could really halt the bear market rally and really make the bear market rally really run out of steam, depending on what those minutes show. So that's going to be really, really exciting. The market, as they currently stand, S&P 500 slightly in the green, near 0.28% on the day. NASDAQ currently trading slightly negative, 0.01%. And the Dow 30 currently trading slightly in the green, 0.28%. Don't forget, you can ask me questions anytime you wish, or simply say hello if you like. Okie doke, not a problem. If you think of a question later, okay, you can put it in the comments section, either Facebook or YouTube. I will see them and I will reply to them next time I go live on air, which of course will be Monday. Monday at 9 a.m. UTC or 9:30 a.m. UTC to cover the European session and any of the developments we've had over the weekend. And of course, again on Monday at 3 p.m. UTC to cover the US session. If there is no questions, not a problem. Not a problem. Like I always say, if you're watching me on Facebook, by all means, give us a follow. If you're watching me on YouTube and you enjoyed this little video, subscribe if you like. Hit the notification button so you know next time I'm going live. If you enjoyed this video, find it useful and interesting, give me one of these. It's nice to know that you like what I do. Anyway, till next time, don't forget, these little videos are for educational purposes only. And in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.